The Entrepreneur's Library, episode 179.
Welcome to the Entrepreneur's Library, the only book-centric podcast that reviews all the top-selling business books and shares authors' perspective firsthand. This is your resource to finding the next great book that will enable you to grow personally and professionally. Welcome your host, Wade Danielson.
Welcome back to the EL. Today we have Marc Lichtenfeld, author of Get Rich with Dividends, a proven system for earning double-digit returns. Welcome, Marc, and thank you for joining us on the Entrepreneur's Library.
Thanks for having me, Wade.
Absolutely. Before we take a deep dive into Get Rich with Dividends, will you take a moment to introduce yourself? Tell us just a little bit about you personally.
Sure. So I'm Marc Lichtenfeld. I'm the Chief Income Strategist at the Oxford Club, and I'm the editor of the Oxford Income Letter, as well as a few other trading services. I'm a former Wall Street analyst. I left the dark side and came over to work with subscribers and individual investors rather than Wall Street. And and just published the second edition of my book, Get Rich with Dividends.
Excellent. So first off, thank you for sharing that. And now let's jump right into the book that you just brought up, Get Rich with Dividends, a proven system for earning double-digit returns, which will be made available. It's not yet available, probably for pre-order, but made available February 24th, 2015. And then, Marc, we're going to move quickly, but we're here to cover the top questions that our listener/future reader would like to get answered. And the first one is, what was the inspiration behind writing Get Rich with Dividends?
Well, there were a few. One of them was the Great Recession, 2008, 2009, and seeing so many people get hurt so badly in the markets and really getting out at the wrong time and not getting back in at the right time. And, I remember as a kid in 1987 when the market crashed, and my dad, who was not particularly a savvy investor, when the market crashed, he panicked, sold everything, and didn't buy back in. And as we know, the market went pretty much straight up after that to one of the longest bull markets we've ever had. And he eventually got back in, but certainly, our family's portfolio was nowhere near where it should have been had he just held tight. So that was part of the reason I wanted to write this book, was to help investors find a way that they could sleep at night, even during difficult market periods, and continue to make money, not just survive a bear market, but even thrive during one. But the other part of it, too, was, with such a large demographic, the baby boomers, starting to retire and in retirement already, I wanted to create a system where not only could they, invest well and build that nest egg and what have you, but find a way to ensure that their lifestyle that they worked so hard for does not deteriorate due to inflation. And, nobody's really talking about inflation right now because it's been so low. But at some point, inflation is going to go higher. Whether it's, I'm not saying we're going back to Jimmy Carter era inflation, but at some point we are at historically low inflation. At some point we are going to tick higher, whether it's high inflation, average inflation, or just a little bit higher from now. And even at low inflation, that does erode buying power, and it can really impact your lifestyle if you're not prepared for it, and if your investments are not at least keeping up with inflation and hopefully beating inflation. So I really wanted to find a way to, like I said earlier, help people ride out the tough times, but also increase their buying power even if inflation goes back to historical average levels or even higher.
So entrepreneurs are inundated with books that come out. You couldn't read the amount of books come out on entrepreneurship alone, let alone investing and buying and selling a business, startups, all that kind of stuff in 10 lifetimes. So this next question is to help differentiate your book from the others. And that's what makes your book different from others regarding the same or similar topic.
Well, a couple of things. I think one is it's a tool. So I've read so many different dividend books and books on business where you read that and go, oh, that's really interesting. I should do something about that. And then you're kind of left hanging, not knowing what to do. And you really need to rely on an expert. This book was really written for novice to medium level investors. I mean, if you're a very active investor and an expert in it, it will certainly open your eyes to some new ideas, but it's really written for the person that you're describing that doesn't have a lot of time and doesn't spend their time on investing sites and reading investing information. So it gives you some actual actionable items that people can take and in order to set up their portfolios in this way that I've described, that will keep up with or beat inflation over the long term and help you ride out these difficult periods that come up in the market from time to time. And I back it up with all the relevant facts and academic research and projections. But the real thing is it's very actionable and it's very easy to understand. You don't have to read the Wall Street Journal from cover to cover to understand what I'm talking about. It is really written. You mentioned motivation. In a way, when I was writing it, my 11-year-old son asked me what I was doing, and I explained it to him, and his eyes got very wide. And so in a way, this was written for him. I mean, not for a child, but written for someone who is new to investing, who needs to be aware of this information so they can get on with the rest of their life and not spend too much time thinking about their nest egg.
So you just talked about who it was written for, and this next question is more focused on how did you write it? So how do you suggest a reader engage with your book? Do you suggest they use it as a tool they can jump in and jump out, cherry picking information as needed, or did you really design it to be read from front to back?
That's a great question. If you have the basic understanding of what dividends are and why they're important, or if you kind of don't really care and you just want to know how to jump into the system, then yeah, you can start in the middle of the book where I talk about how to go over a portfolio and how to set up the system and what kinds of stocks qualify for this 10, 11, 12 system, which I should mention. Going back to your last question, how is this different? So this is an actual system that's designed to generate 11% yields within 10 years, or if you're reinvesting the dividends, 12% average annual total returns. And 12% may not sound like a lot, but when you're compounding that year after year, that triples your money in 10 years. And that's really, under pretty much any circumstances, this should work over the long term. So you can dive kind of right into that section of the book. There's other sections on options and taxes and tax-deferred strategies and foreign stocks that you can also kind of cherry pick. But the beginning, probably the first third of the book, is really about dividends, why these kinds of dividends-paying stocks work, historically, what they've done, how you can project what the results could be in the future, why companies raise dividends. So that first third of the book is really a very basic understanding of dividends and the landscape and how it all works. And once you do have an understanding of that, you can go into the actual system.
Perfect. So, Mark, now that we know the purpose and the background behind the book, let's take a deep dive into the content itself. So we take the next 5 to 8 minutes and give the listener and the future reader a great idea of what they can expect to get out of your book.
Sure. So as I mentioned, we start off talking about dividend stocks, what they are, why they're important. And so, the first chapter is called Why Dividend Stocks. And there's all kinds of academic research, and it's not laid out in a boring academic way. But I talk about how much these stocks have outperformed over history. And you're taking a long-term look at the stock market. So it's not just the last 10 years, which have been, or 15 years, which have been a pretty remarkable period in time. But really looking back over 100 years, almost 100 years, we'll go back to about 1927. At the historical average of the markets and dividend payers. And typically, dividend payers outperform the market. They're safer when there's a bear market and stocks go down. Dividend paying stocks typically go down less. And then I really get into and kind of the key concept for the book and the kinds of stocks we recommend are what I call perpetual dividend raisers. And that's in chapter 2. And a perpetual dividend raiser is a company that raises the dividend every single year and has a track record of doing that. So typically, I like to see a company with at least 5 years or more of annual dividend raises. Often, it's much longer than that. One of my favorite stories is a company called Genuine Parts. GPS is the ticker symbol. They've been raising the dividend every year since 1956. And 1956, Eisenhower was in the White House. Elvis Presley was making his television debut on a small show called the Louisiana Hayride at a Shreveport. So that was a long time ago. And so I love stories like that where these companies have raised the dividend every single year, no matter what's been going on in the economy, in the markets, in the world, I mean, you think about everything that's happened since 1956, the Vietnam War, Kennedy assassination, Watergate, Iran-Contra, the inflation from the late 1970s, early 1980s, just keep going down the line, all the terrible things that have happened in the world and in the markets. And this company just year after year keeps raising the dividend. And there are several hundred companies like that, which really probably surprises a lot of people. And so I really get into why these kinds of companies are so important and are such a critical component of investing and creating a portfolio that's going to get you where you want to go. There are a lot of people that get into the markets for the adrenaline rush because they like to trade, they like to invest, it's fun. And other people want to invest to reach a goal, to have a nest egg, to create income, and they don't want to mess around with it. And these perpetual dividend raisers are really for the latter group, for the group that kind of wants to set it and almost forget it. You can't never look at your investments, but if you're investing in a company that's raised the dividend for 25, 30, 40 years, generally speaking, checking in just once or twice a year and you're going to be okay because these companies have this great track record and they know how important it is to their shareholders that they continue to raise the dividend. That's the reason that so many of these investors are involved in the company. And that goes into one of the chapters I call Why Companies Raise Dividends, because it really goes into kind of the executives' mindsets. And I have interviews with a couple of executives on how they think about dividends. I also talk about really how boring dividends can be. These stocks like a Genuine Parts or a Procter and Gamble, Coca-Cola. Some of these companies really are snoozers. They're not exciting companies. You're not going to day trade them. And you are going to set it and forget it, but they do consistently outperform the market year after year, in large part because they are increasing the dividend year after year. And then, as I mentioned earlier, I talk about the system and the portfolio, how to set it up, the kinds of stocks we're looking for, what the variables are for these stocks. So, so you'll know how to look at the market and look at just a couple of different variables and say, okay, will this stock qualify for this system? Which again the goal is to generate 11% yields or 12% average annual total returns within 10 years. And I should mention that 12% average annual return is annual over the course of 10 years. So it's not in year 10, that's what your average will start to be. It's within 10 years, your average annual return will be 12%. And then towards the end of the book, I go into some of these other topics like dividend reinvestment plans and how you can do it directly through the company, options, foreign stocks, taxes, and a summary. There's also a glossary for anybody who doesn't know or needs definitions if they're not too familiar with investing. But like I said, it's really written for novice investors to mid-level investors. So it's not going to be too difficult, even if you have very little experience in investing.
So if that novice or intermediate investor could only take away one concept, principle, or action item out of your entire book, everything that you just took the time to discuss with us, what would you want that to be?
That if you invest in these stocks for the long term, and you really have to have a long-term focus. You can't say I'm going to be long-term and then we hit a bear market and you get scared and you sell everything. So if you really have the discipline, the intestinal fortitude to ride out any kind of difficult period in the market and can invest in the long term using this strategy, using these types of stocks, generally speaking, you are going to get to where you want to be financially. You are going to reach those goals. It's a system that works. I mean, and it's not just a theory. It has worked for almost 100 years now, and all kinds of markets, all kinds of things that go on in the world. And I really want to emphasize to people, and it's why I'm so focused on the long term, because markets kind of do what they do. They revert to their historical averages over the long term, no matter how dire things look. And things have looked pretty bad from time to time over the last 100 years or so. There's always a reason to be scared. There's always a reason to be bearish on the market, to be negative, to hold your money out of the market and try to conserve your capital, not put it at risk. But over the long term, stocks go up. And they have for years and years and years. And so if you can commit to ignoring the media and investing for the long term, you are going to make money. And I even show you in this book, if we do hit a prolonged stretch of a bear market, the nastiest bear market we've ever seen, but you're committed to investing this way, you can still make money. You can still come out ahead.
Excellent. Well, Marc, do you have a favorite quote from your book? And if you do, will you take a minute to explain what it means to you?
Sure. Well, my favorite quote, kind of expanding a little bit on what I just talked about, is that a bear market can be your best friend. And this does not involve selling short or buying puts or anything like that. But the basic idea is, so when you reinvest a dividend, you get paid a dividend by the company, and it's automatically used to buy back more shares. And you don't pay commissions on that. It just automatically happens. And so when that happens, you own more shares, which then kicks out more dividends, which buys more shares, which kicks out more dividends, and so on and so on. And so it really puts the compounding machine into overdrive. Well, when you hit a bear market, what happens is your stock price goes down. Now, the dividend does not go down. That's really important to remember. Just because stocks sell off doesn't mean the dividend is going down. So 2008, 2009, when stocks sold off by 50%, there were still several hundred companies that raised their dividend during that year, even though their stock prices got hit hard. And so now imagine you own a stock at $20 and you're paid $1 per share in dividends that's automatically invested in the dividend. And now we hit a very nasty bear market. And now that stock is worth $10. Well, the company is still paying that $1 dividend. They didn't cut the dividend. In fact, they might have raised it. And so now you're getting, let's say, $1.10. But now instead of paying $20 a share, you're paying $10 a share. So you're buying even more shares, which generates more dividends, which buys more shares. And so when you have a bear market and you're buying all those shares, it's really a chance to accumulate a very large number of shares, which can generate a significant amount of dividends. So that's where you can really, really get that compounding machine into overdrive. So really the only time you should care about a bear market is when you're getting ready to sell. If you need the nest egg to live off of, then obviously a bear market's no good. But if you're getting ready, if you're at that point in your life, you shouldn't be in the markets anyway. You should have been scaling back. But if you still have 5-10 years and we hit a bear market and you're reinvesting those dividends, that could be the best thing to ever happen to you, because it's going to allow you to accumulate so many more shares that hopefully by the time you are ready to retire and you're going to live off the income from this nest egg, it's going to be generating so much more income for you than it would have if we hadn't hit a bear market, that it's going to turn out to be the best thing that ever happened to you. So that's why, as long as you have that long-term perspective, the bear market can be your best friend.
So, Marc, this next question, it doesn't have to necessarily be over investing whatsoever. Matter of fact, it doesn't have to be over business. And that's, if there's only one book you could recommend to our listener, based on the way that it's impacted your life, created maybe a paradigm or a lifestyle shift, what book would you suggest?
Well, it would be an investing book. It would be Contrarian Investment Strategies by David Dremen. He's considered kind of one of the godfathers of, or father, I should say, of contrarian investing. And contrarian investing is basically going against the crowd, which is a very difficult thing to do in a lot of cases. And a lot of the stocks that I choose in my newsletter, not necessarily that are in the book, but in my newsletter, the Oxford Income Letter, are stocks that are very much against the crowd. They're beaten up stocks. And as a result, often have high dividend yields. But it's really a way of, it really kind of shaped how I look at investing and made me realize how wrong both the mainstream media, mainstream investing media is, and how wrong so many investors are, and how they just do the wrong things at the wrong time. And that very often, if you go against that crowd, it works out very, very well.
Well, thank you for that book recommendation. That's actually the first time that we've had that one recommended. And Marc, before we depart, can you recommend the best way for our listener to get more information on you and your book, Get Rich with Dividends?
Sure. They can go to getrichwithdividends.com, or the book is available on amazon.com. And also our newsletter, Oxford Income Letter, you can read all about that at oxfordclub.com.
Excellent. And we'll put those in the show notes so people can go back and check out those links. Marc, thank you so much for coming on and sharing your book with us.
My pleasure. Thanks so much for having me.
Thanks again for listening in today. If you'd like more information on Marc or his book, Get Rich with Dividends, check out the show notes at the elpodcast.com. And as always, if you'd like to win a copy of this book, visit the elpodcast.com and click on Become a VIP.
Looking for your next book idea? Head over to the elpodcast.com, where Wade shares his amazing resource, the top 10 business books recommended by over 500 entrepreneurs, with you for free. That's the elpodcast.com. Till the next time, keep it on the EL.